Hi everyone. First of all, we deal with matching of revenue and expenses, correcting and adjustment accounts. This is CPF Financial Lecture by Eli Online CPA CFA Institution. Let us discuss about the basic concepts. Basic concepts of accounting. So first is asset. Okay. So asset means here we are talking about the fixed assets means uh, other than cash. So assets are probable future economic benefits that are obtained by an entity which produce the revenue, which are producing or generating the revenue. Okay, assets are feasible future economic values or benefits of an entity. Each asset must have two characteristics, A and B. Here I am mentioning A and B, two characteristics. Asset must have a capability to generate the revenue. So without generating any revenue, we will not consider it as a asset. So those are the non-performing assets. Assets which are creating the revenue for the company only considered as real assets. And asset must be retained in our business for a long time. It is more than one accounting year. It is more than one accounting year and must be generate revenue for the company. So assets increases the value of the company. Hence, the value of the asset increases with the day-to-day transactions and events. Okay, day-to-day transaction and events means sales. Okay, production of goods and services, sales, everything, whatever we are producing with the help of the asset and we are selling in the market, we are generating the revenue. The profit or loss, it's not considerable. So only generating the revenue is most important. Next is liability. Liabilities are future economic give ups. So we are giving back, we are giving to other parties, we are giving from our organization. Liabilities are duties of the organization. Liabilities are future economic give ups of an entity due to the past events and transactions. So we already purchased goods from the company, so other company, we have to pay back now, so we have to give up. Okay, so these are our duties, we are responsible in payment of the liabilities. So these are the future economic give ups. Liabilities are unavoidable dues of entity. So these are unavoidable dues, we have to pay, that's it. Okay, that is a lot of difference in between their assets and liabilities. Assets generate the revenue. If we have a liabilities, if we pay liabilities, the cash goes down, means asset value goes down, current asset value goes down. Okay, next is realization principle. This is the principle, it is related to the accounts and revenue accounts, revenues, assets and liabilities of the organization. So realization means conversion of non-cash resources, simple assets. Okay, assets are, what are the assets? Okay, PPE, property equipment plant, property plant equipment asset. So we are converting these assets into cash, means we are selling those assets and getting the cash. So assets are sold out and getting the cash. This is nothing but the realization of the cash. Realization is nothing but conversion of non-cash resources to cash, selling the property plant equipment like these assets and getting the cash. Entity sold its assets and received the cash, called realization. Okay, next, recognition. Recognition means recognition, we are recording the actual reasonable transactions and events in the financial statements. So in the previous example, we sold the property, so that is recorded. So what is the entry? We are receiving the cash, cash is debited, and what is the credit? Our property or plant or equipment will be credited. So it is going out from the organization. So recognition, we recognized, we are recorded. Okay, next, matching principle. Here the most important thing here in accounting is matching. So we have to match our all costs with the revenues. Okay, according to the matching principle, expenses must be recognized in the same period. Same period means same accounting period in which they related to the revenue, in which the related revenue is recognized. Okay, so for example, in this financial year you are recognizing expenses, so expenses which are related to the cost. Okay, so you are recognized $100 expenses or cost which are related to the wages. Okay, wages. So you are producing this worth of goods and sold in the same period or in the next period. For example, sold. Okay, sold. So goods worth rupees you sold for $120. So you are recognizing the revenue in the financial year 15. In the same period you have to recognize this cost in financial 15, in the financial year 15 only. So again I am reading this. According to the matching principle, expenses must be recognized in the same period in which the related revenue is recognized. So the related revenue of 120 is related to the cost of this 100. So you have to recognize in financial year 15 only. Okay. Some period costs like depreciation, amortization are recognized based on other rational approaches. Okay. So it is because the expenses which are paying outside. Okay, so you are recognizing the same period. So when come to the expenses which are internally created like depreciation and amortization will be recorded separately. Means will be recognized based on some other rational approaches. Next, accrual accounting. So we have a cash accounting, cash based of accounting system and accrual based of accounting system. Now I am talking about the accrual based of accounting system. Here, accrual base of accounting system. According to the accrual basis accounting method, the revenue recognized as the occurrence, okay, on the occurrence of the events and transactions, but not when the cash is received or expenses. So, in the same manner, your expenses are $100, okay, right? Your expenses are $100. So, those are expenses you paid out, but that is not recognized in the same year. You recognized in the next year because the related revenue generated in the next year. So you have to wait. So it is also related to the matching principle. Okay, accrual base of accounting system means there is no there is no need to consider when they happen, when the cash is received, but we have to consider where that is occurred, in which period that is occurred. Okay, next, revenues. This is the most important point. I explained the accrual and matching principle, so based on that the revenues should be recognized. So revenues are the positive outcomes, so positive outcomes, right? So you are receiving the revenue, that's it. You are selling your goods and getting the cash, so that is revenue of major ongoing operations. The major ongoing operations of the company is different to each and every company. So our major operation is selling, for example. So you sold the goods, so you are receiving the revenue. Cash is generated through the revenue, the cash revenue. Okay, next. So revenue recognition is different in case of gap and in case of IFRS. Revenue recognition means detection of revenue. Every inflow may not be considered as revenue of the company. Every inflow is not considered as a revenue. Only revenues are recognized, only realized. So you are received the cash. For example, they want to buy products in the financial year. Some other party wants to buy products in financial year 17. So but due to some other reasons they paid in advance they given in financial year 16. Okay, in financial year 16. So this is a inflow of cash, but it is not the revenue. So the real revenue will be in financial 17 because you are providing the goods in financial year 17. So they paid in advance. That will not be acceptable. The received in advance is not the actual revenue, that will not be recognized as the revenue. Okay, next. Sales revenue recognized only on the date of sale. Okay, sale event, but not received on the same day. So this is accrual basis. Just now I explained the example. Revenues like interest, royalties, rent, etc. are recognized as per the time and use of the asset by others. So you are receiving the revenues like interest and royalties, rents. So you are receiving the revenue royalty because you have the patents and given to some other party, the other party using it. So when they use, then they will pay the royalty. Sometimes they will pay in advance, that will not be considered. Okay, sometimes they will pay in the next coming years, they will pay in 6 months later, 7 months later, or sometimes 1 year later. So you no need to wait till 1 year because they didn't pay it. So but they used it, so you have to consider in this year as dues, royalty dues. So your asset, they have to pay whenever you ask, they will pay. So that is your current asset, you have to recognize as a current asset, as a revenue. So sometimes they paid in advance. So when they paid in advance, so that is not related to this financial year. Next year they will use your property. So you have to wait till next year. Till now, till the next year, the amount is in your pockets. So you have to write it as a current liability. So next year, the current liability becomes zero, and next year the revenue generation of the same amount will be increases. Okay, so that is the adjustment. Okay, next. So according to the IFRS, excuse me, according to the IFRS, revenue recognition, revenue from the sale of goods recognized only the cost associated with the sale measured reliably. So reliability is more important in case of IFRS. Next, economic benefits from the sale transactions must flow to entity. Okay, the economic transactions which are related to the sales come to the organization. So then only you have to recognize, and the risk transferred to the buyer. Whoever the purchasing the product, the risk is goes to him, reward is comes to us. Risk and reward sharing is most important. That should be in reliable manner. Okay, when come to royalty and dividends, interest incomes recognized when they are reliably measured. So again here reliability is most important, and measured. Economic benefit from the organization must flows to an entity. Same, otherwise we can't record it. So when come to interest calculations, we will use effective interest rate method. Effective interest rate method, we will discuss that later. Effective interest rate method used to calculate interest. Royalties are recognized on the basis of accrual base of accounting system. You know this accrual base of accounting system. Okay, and dividends is only real shareholders. So means shareholders have right to receive the dividends. They don't have a right, then that should not be recognized as a expense. Okay, when come to contract revenue and costs are recognized using the percentage method of contract revenue, we have to use percentage of completion method. For example, so 100% of the work, so you completed the work till this year, you completed the work till this year 50%. So you have to recognize revenue only 50%, even though you received the full amount, but you should not calculate this entire revenue. You have to calculate only 50% because the 50% work is completed. So only 50% of revenue should be recognized on the base of percentage completion method. We have problems on this in the next coming chapters. Next, in the same manner, the cost is also, the expenses which are related to the uh, company is also recorded according to the percentage completion methods only. In construction contracts, for construction contracts. Next, expenses. Expenses increases the liabilities and reduces the assets. Means you are paying the amount, to outside, so your cash balance reduces. Okay, so expenses increases liabilities and decreases the assets. They incur to provide goods and services. The expenses incurred must be related to the production of goods and services, or providing the goods and services to the other persons. So which are related to the basic operational activities of the organization. The expenses are recorded according to the matching principle. We already understood the matching principles. Deferred means if we are using accrual basis of accounting system and according to the matching principles, there is a deferrals, deferred revenue or deferred expenses will happen. So deferral of revenue or expenses will occur when cash is received or expended but not recognized for the financial statement purpose. So you paid already. For example, you paid insurance premium. Okay, insurance premium you paid. Okay, the payment of insurance premium paid. So we can say 1200 USD. Okay, $1200. So what happened? This is related to 2 years, for example. So this year, how much? Only 600. Okay, and next financial year, again 600. So year 1, year 2. So you paid both 1200, both amounts in the same year. So this is your real expenses. So this become your deferral. Okay, this is your real expenses, and remaining 600 whatever you paid in advance. So that is 600 is a deferral. That is cash paid, it is expended but not recognized as the expenses for this financial year, which is related to the year 2 you paid in advance. Okay, deferral uh, deferral typically results in the recognition of current liability or prepaid expenses, so current assets. So the 600 in our example, year 2 600 is our prepaid expenses, prepaid insurance expenses. Okay, next, accrued assets and liabilities. We know revenue recognized through the percentage of passage of time but not received, right? In the same manner, so earned revenues which not received, earned revenues, we earned the revenues which not received, considered as a accrued asset. So for example, I provided the services to the party, but I didn't receive the amount. He will pay in the next year. So he didn't pay till now. So what will happen? So I worked it, I earned. So I have to take it in this year only. I have to recognize as the revenue earned but not received. So that is the due. That is my current asset. Okay. So earned revenues which not received considered as a accrued asset, like interest receivable. Okay. Revenues receivable. Okay. Same as expenses. Same as expenses recognized or incurred passage of time. Sorry, through the passage of time but not paid. Okay, so I already received the services but I didn't pay the amount, so I have to pay. That is my liability. In future I have to pay. Okay, so even though didn't paid, I have to record it so as a accrued liability. So there is a liability in my accounts. Okay, that the example is expenses for the period but not yet to be paid. The example is accrued expenses like accrued interest payable, accrued wages. So outstanding wages payable. Okay. Next, prepaid expenses. We already discussed about the prepaid expenses like prepaid insurance. So now we will discuss one question here. So accrual revenue. Example, accrual revenue. Once again, right? So read the question. VEGA company wrote a book. So VEGA is going to receive royalties, right? Okay, VEGA is going to receive royalties and given to Beck company. Beck company is payer. Okay, royalty payer for a royalty of 1/4 of the sales. Okay, so for example, sales is $100. Simple example, sales is $100. Then the royalty will be $25. Okay, royalty will be $25. Okay, royalty and sales, just for understanding I am writing here, right? Got it. So VEGA company wrote a book and given to Beck company for a royalty of 1/4 of the sales and payable as follows. First point, semi-annually, the royalty is paid to VEGA semi-annually on two dates. Semi-annually means per year they will pay two times. That is 30th April. So that is they sold from July to December. They sold from July to December. So they calculate royalty on the sales of July to December. They will pay in the month of April. Okay. Right. So in the previous year sales of July to December, they will pay in the April. So in this financial year, we will receive on 30th April, which are related to the previous year sales. Got it? Previous year royalty. Understand? Right. And on October 31st, they will pay. That is this year, January to June, they sold. Na? January to June sales, they will pay on October this year. Okay. So we are receiving royalty in every year two times on 1st April, sorry, on 30th April, which are related to the previous year July to December sales. After 4 months, they are paying. And again, we are receiving on 30th, 31st October, which related to the sales of January to June. So we are receiving two times. So according to the Vega books, we have royalties like this: year 1, year 2. So these are related to the last year. Okay, previous year. This is related to the current year. Okay, right. Third point, estimated total sales for the second half of the year 2 is 100,000. Okay, 100,000 is the sales of which year? uh, second year sales is 100,000. So we know, very simple, how much royalty revenue in the second year, how much royalty revenue should Vega report. Actually this is Vega. Yeah, how much royalty revenue Vega, how much royalty revenue should Vega report for year 2 in income statement for the December 31st year 2? So year 2, this is the year 2 sales in which 25% will be calculated, right? So very simple, for year 2 royalty will be royalty. So 0.25 into 100,000, right? So that is 25,000. Very simple. And the most important point here we have to understand is year 2 royalties. Year 2 royalties we are receiving October 31st. Year 2 royalties only I am considering these 2 points. Okay. Year 2 royalties receiving October 31st and April 30th. April 30th, 14,000 royalties which are related to the previous year. So previous year royalties will not be considered, right? Only this year. This is related to the this year 2 January to June sales. So this is related to our current year, right? So that is 17,000. 17,000. So total how much? Right? Total how much? 42,000 is the royalty for year 2. Okay. So I calculated like this. So October 31st year 2 direct check amount is 17,000. Okay, direct check amount is 17,000 and earned royalties for year 2 but not received. So unearned royalties. Okay, earned royalties but not received. So outstanding receivables, royalty receivable. Okay, receivable, royalty receivable 25,000. Total is 42,000 royalties revenue for year 2. Second question, most important question again. So these type of question they will ask in our CPA exam. Royalty received in advance. Vega Corporation receives royalties on its patents in advance and sometimes in 2 months delayed. 2 months delayed. We also understood the concept in the previous topics. The following data available in Vega's December 31st balance sheet. Royalty receivable, unearned royalties. Okay, that is year 1, year 2, difference they given. Okay, so during the year 2, Vega received the royalty remittances of 360,000. How much royalty income should report in its financial statement for year 2? Again, year 2. So, Vega received royalty remittance. Total royalty received how much? 360. Okay. Total royalty is 360,000 received. Means total remittance. This is received only. Please understand. This is royalty received. Amount received for royalty. Okay. Amount received. Right. So 360,000 and so the difference is 5,000 and difference is 25,000. What are these differences? So royalty receivable means we are going to receive. We already earn the royalties. Understand? We already earn the royalties which are receivable 120 in year 1. When come to year 2, the reduction is 5,000. Okay, the reduction is 5,000 means earned royalty already received. This is not related to this year. Got it? Okay, previously the royalties are outstanding royalty receivable year 1, so that is earned in year 1 and received in year 2. How much? 5,000, right? 120 is the previously, 120,000 is the year 1. When come to year 2, that become 115, so 5,000 reduced. So royalty receivable reduced means previous year royalty is received in this year, so which is not related to our financial year, current financial year. So already which 5,000 included in 360, right? So the 5,000 will be deducted. 5,000 will be deducted. Okay. The value is 355,000 is the royalty related to this year. We are assuming. Okay. And next one. Next one. Unearned royalties. Unearned royalties unearned. Okay, right? Means we received in advance. Unearned, advance, received in advance, right? In advance, received in advance is 175 in year 1. When come to this 150, okay, 150, so it is also reduced, right? Reduced. But the thing is here 175 became 150. It is I am writing positive, positive, right? Here also I am writing, I have to write positive, but I written negative because that should be not related to our company. That is the reason. And here 175 minus 150. So what happened? Unearned royalties. Unearned means unearned means received in advance. Very good. Received in advance. Royalties received in advance but not earned. I have to work, they have to produce goods and services, then only they have to produce this good books and they have to sell, then only they become earned. So the earned royalties are 150, right? Received in advance become reduced. So that 25,000 earned in this year. Got it? This 25,000, this 25,000 earned this year. Okay? Earned. So we have to add it. 25,000 should be added. So total how much? 0, 8 and 3. 380. Okay? So year 2 royalty income cash receipts 360 minus 5,000 plus 25,000 is 380 is the royalties will be shown in the financial statements of Vega for year 2. And I am giving explanation why these are deducted and why those why the 25,000 added. Okay. Receipt in year 2, 5,000 applied to year 1 receivable means earned in year 1. So not related to the year 2 earnings. So reduction in the royalty receivable 5,000. Okay. Next, add unearned royalties in year 1 reduced by 25,000, which means royalty received in advance earned in the year 2, 25,000. So earned in year 2 means earned related to this year, earned. Okay, whenever we are receiving it, we did not consider it. When we earned it, then only we can consider. Okay, so this if you like this class, please press like button in YouTube, and if you have any doubts, please post there. I will also upload new videos. So if you need your help in teaching, please contact my email ID. So this class is presented by Eli Online CPA Financial Institution, CPA CFA Financial Institution. I am always happy to help you. Please contact. Thank you.